Hi, what I'm going to do now is to work through the accounting treatment for deferred taxes, and this follows on from our previous consideration of current taxes. In the interest of simplicity, I'm retaining the same basic fact scenario, and here we have the same company, commenced operations in 2016, and we're thinking about the scenario at the end of the year 2017. Because I'm commencing operations on the 1st of July at the beginning of the year, I don't have to worry about any opening balances, and that makes life much simpler. The critical point to note is that there are a number of items where there are going to be differences between what's in the accounting balance sheet and in the tax balance sheet. For example, for accounting purposes, we have to recognise a long service leave expense, and we're going to have a provision for long service leave as a liability. However, that's not going to be the case for the tax balance sheet, and so there's going to be a difference between the accounting and the tax balance sheet, and that creates a temporary difference. So that in this case it's going to be a deductible temporary difference, and we can see that these temporary differences are also going to arise with respect to the warranty expenses, the insurance which is prepaid, and the depreciation. So what we need to do is we need to think about what the accounting and the tax balance sheets look like for these items. You will note that these were also adjusted in the determination of taxable income. It's a matching process. So if we look at the accounting balance sheet, carrying value, and the tax balance sheet, tax base, what we can see is that the prepaid insurance has a value of $5,000 for accounting purposes, for tax $0. So there's a difference there of $5,000, and that's a taxable temporary difference. The depreciation is different. So we have the plant, which has an accounting carrying value of $480,000 and a tax base of $450,000, a difference of $30,000, and so that gives us a taxable temporary difference of $30,000. Down on the liabilities, we have a warranty expense and a liability of $35,000 for accounting purposes, none for tax, so that creates a difference of $35,000. And for long service leave, we have a similar issue. So what we can see happening here is that we've got some taxable temporary differences of $35,000 and some deductible temporary differences of $65,000. So we need to work out the deferred tax asset and the deferred tax liability. The deferred tax liability is $35,000 at 30 cents in the dollar, $10,500. The deferred tax asset is $65,000 at 30 cents in the dollar, that's $19,500. And we'd recognise a tax expense for the combined effect of those. So we'd recognise a tax asset, a deferred tax liability, and the difference is recognised as a tax